Welcome back to the Deep Dive. Today we're diving into some fascinating signals from the financial markets. And sometimes, well, conflicting signals, let's be honest. Our mission, like always, is to cut through that noise. We take our stack of sources, articles, research notes, and really try to pull out the important stuff for you. We'll look at key economic data, central bank moves, what's happening in specific sectors, aiming for a clear picture of what's shaping things as of Friday, September 12th, 2025. And we've really dug through a ton of material this week. Economic calendars, market sentiment stuff, expert commentary, breaking news. It's all curated to give you, the fast track to understanding what's actually moving the markets without getting totally overwhelmed. So diving right in. Let's start with the mood. What's the emotional landscape telling us right now? Optimism, caution. What's the vibe?
Well, what's really striking this week is this palpable shift towards optimism. It feels quite strong. If you look at something like CNN's Fear and Greed Index, the one, it gauges if stocks are driven by too much fear or maybe too much greed.
Right, the composite index.
Exactly. It's definitely reflecting that optimism. It pulls together 7 indicators, things like market momentum, the S&P 500, versus its 125-day average stock strength, options data. And the headlines back this up, don't they? The Dow crossing 46,000, stocks hitting new records. And a lot of this buzz, as we'll see, seems tied to this growing belief about Fed rate cuts coming soon.
That's a strong read on sentiment. Okay, so how are the main U.S. equity markets actually, reflecting this? Is it broad-based or still just the big tech players doing the heavy lifting?
No, it absolutely looks like broad participation, and that's really key for understanding if this rally has legs. As of today, September 12th, the major U.S. indices, all at record highs. S&P 500 at 6587.47, the Dow Jones at 46108.00, NASDAQ at 22043.08.
Wow.
And what's more, if you look at data from finviz.com, the market breadth is impressive. Something like 73.9% of stocks advancing, 84.6% hitting new highs.
That's significant participation.
It is. And it's not just tech this time. We're seeing strength pick up in small caps, in cyclical stocks too. That often suggests, a more sustained, more robust market move. Deeper confidence.
Okay, right. Here's where it gets really interesting then. Because, like you said, this optimism seems almost totally anchored to the Federal Reserve. So what specific economic signals came out this week that gave the market such conviction about the Fed's next move?
You're right. The Fed is absolutely front and center, and the economic data this week, it's pretty much laid out a path for them, or at least that's how the market sees it. Let's start with inflation. The U.S. core CPI for August. It came in at 0.3% month over month, 3.1% year over year.
Okay.
Which was, broadly in line with what everyone expected. This tame CPI print, as some called it, is a key piece reinforcing those rate cut hopes.
So no big inflation surprises.
Exactly. But maybe the bigger news, the more surprising part, was the labor market. U.S. new jobless claims jumped dramatically. A nearly 4-year high, actually, highest since October 2021.
Wow, okay. That's a big jump.
It really is. And it's not in isolation either. It comes after downward revisions to annual employment data. And remember those weak non-farm payroll numbers from the previous week.
Right.
It all points towards a distinctly softening job market. And you can see this reflected in the CME FedWatch tool. The one tracking probabilities based on Fed funds futures. It's now showing the market fully pricing in a 25 basis point Fed rate cut at the next meeting. That's September 17th.
Fully priced in. So the market's decided.
Pretty much. And it's not just market pricing. Expert commentary lines up too. Bloomberg sources, for instance, mentioned Morgan Stanley now sees 4 straight 25 basis point cuts.
4 straight? Okay.
PIMCO even suggested a 50 basis point cut might be on the table for discussion next week, though they're sticking to a forecast of 75 points in total cuts this year. Rigging Capital is also calling for 0.25 next week, then 2 more 0.25 point cuts before year end. So yeah, the consensus is quite strong now.
Okay, so we've got softening inflation, a cooling labor market, maybe rapidly cooling, and these really quite oppressive rate cut predictions. What does this all mean for that Goldilocks economy scenario we keep hearing about? Is this it? Are we finally there?
It really does feel like the markets are buying into that Goldilocks story this week. What that means, essentially, is finding that sweet spot, right? Inflation is behaving well enough for the Fed to feel okay about cutting rates. And the labor market is softening just enough to justify multiple cuts, perhaps.
But not collapsing.
Exactly. But crucially, overall economic growth stays reasonable, resilient. It's this delicate balance, not too hot, not too cold, that seems to be driving sentiment right now. It's that hope the Fed can ease policy without tipping the economy into a deep recession. a pretty desirable outcome.
That's a fascinating picture here in the U.S. Now let's zoom out a bit. How are these expectations, especially for Fed cuts, playing out globally, particularly in key currency pairs?
Yeah, globally, the immediate effect is a softer U.S. dollar. The Bloomberg Dollar Index slipped. Now, normally, Fed cuts weaken the dollar, that makes sense. But it's also worth remembering there's a kind of global rebalancing happening, too. Other central politics matter, geopolitics matters.
Right, it's not just the Fed in isolation.
Precisely. So take the euro, for example. It got a lift against the dollar, trading around 1.17377. A big part of that was the European Central Bank, the ECB. On September 11th, they decided to keep their rates unchanged at 2%. That's the second meeting in a row.
Holding steady.
Yeah, and they basically ruled out more cuts unless there's some kind of large shock. They seem pretty confident about hitting their 2% inflation target without more easing. So that creates a divergence, right? The Fed expected to cut, the ECB holding. That naturally supports the euro versus the dollar.
Okay, so divergence favoring the euro. What about the yen? Always an interesting one.
The yen, yes, saw some volatility. It initially weakened against the dollar after the US CPI data came out, hit maybe 148.17, but then it recovered pretty quickly, back around 146.99. Still, it's described as lagging G10 peers, the big developed economies. It suggests the market isn't fully sold yet on the Bank of Japan making a big policy shift, even though expectations are building for the BOJ to start hiking rates later this year, maybe October.
So still some waiting and seeing with the BOJ.
Definitely. Their next policy decision is September 19th, so it's a big one to watch for the yen. And you can see some of this caution reflected in trader positioning data, like the ONDA order book for USD-JPY. It shows specific biases, hinting at that underlying uncertainty.
So currency is definitely moving. What about bonds, U.S. Treasury specifically? Are bond investors seeing the same clear path for lower rates?
Oh, absolutely. U.S. Treasury yields have continued to fall, directly reflecting those rate cut expectations. The benchmark 10-year yield, it's nudging down towards that 4.02, 4.03% range.
Yeah.
The 30-year is around 4.66%, the 2-year at 3.54%. And falling longer-term yields, well, they generally signal market expectations for maybe lower growth or lower inflation down the road.
Yeah.
And that, of course, feeds into things like mortgage rates.
That makes sense.
What's also kind of interesting is seeing the unwinding of these steepener positions on the yield curve.
Explain those quickly.
Sure. They were basically bets that the gap between short-term and long-term bond yields would get much wider. The fact that people are backing away from those bets suggests maybe less conviction in that sharp widening now, perhaps expecting more moderate growth or inflation ahead.
Got it. Okay, let's pivot to commodities. Oil and gold. How are they reacting to all these dynamics? Are they reflecting this rate cut optimism too?
Well, gold spot prices saw their losses pared back a bit, ended slightly lower, but still finding support from those Fed rate cut expectations. Gold's actually had a really strong year, hasn't it? Prices up nearly 40%. It benefits from inflation hedging, safe haven appeal, and potential rate cuts definitely help. Oil is a more complicated picture. New York WTI futures for October delivery fell about 2% to $62.37 a barrel. Brent crude for November dropped 1.7% to $66.37. The oil market seems caught in this sort of tug of war.
How so?
On one side, you've got the International Energy Agency forecasting a record oil surplus in 2026. That points to plenty of supply down the line. But on the other hand, you have ongoing geopolitical supply risks. Increased sanctions on Russia and Iran, tensions in the Middle East, even those recent Russian flights into Polish airspace.
Right, things that could disrupt supply.
Exactly. So those concerns put a floor under prices. And it's this tension, this dynamic that seems to have trapped crude prices roughly between $62.7 or $67 a barrel since early August.
Fascinating. So many interconnected forces. Okay, beyond the big numbers and broad markets, there are always interesting stories in specific sectors and globally. Let's dig into some of those undercurrents. Starting with tech and AI, it feels like it's always making headlines.
It really does. The tech sector and AI are still huge themes.
Yeah.
We saw a few key developments this week. First, OpenAI and Microsoft reached a preliminary agreement on how they'll structure their partnership going forward. It involves creating a new public benefit corporation, a PBC.
A PBC? What's the significance of that?
Well, a PBC tries to balance making profits with achieving social responsibility goals. It's an interesting structure for such a massive venture, especially with OpenAI committing $100 billion to it.
$100 billion, wow.
Yeah. Then you have Micron Technology. Their stock has just surged, up over 80% this year alone. Best performer in the Philly Semiconductor Index. That came after a Citi analyst upgrade. They're expecting a really bullish forecast for data center revenue when Micron reports earnings on September 23rd.
So more AI demand driving chip makers.
Seems to be the case. And speaking of AI infrastructure, news commentary suggests the CEOs of NVIDIA and OpenAI are set to announce billions in UK data center projects next week. They're teaming up with InScale Global Holdings.
More big investment in the UK. And on the Cure Innovation side, SK Hynix announced they've completed development and are ready for mass production of High Bandwidth Memory 4, or HBM4. That's a big step for AI chips, faster, more efficient memory.
Okay.
Now, while that whole AI theme is clearly still very strong, it's worth noting. Some commentary suggests investors should probably still diversify, be ready for maybe some interim pullbacks, even within this growth area.
Right. Nothing goes up in a straight line forever. Good reminder.
Yeah.
So tech is humming along. But what about those broader geopolitical currents? Trade tensions, what else should we be aware of?
Yeah, beyond the economics, some significant geopolitical stories are unfolding with real implications. Look at Mexico. They're proposing tariffs up to 50% on Chinese imports. Things like EVs, auto parts, steel.
50%, that's high. It is. It's aimed at protecting their own industries. And it's especially notable because Mexico actually overtook Russia as the top destination for Chinese car exports recently. China, predictably, reacted strongly, called it appeasement towards U.S. bullying. It really highlights this ongoing global supply chain reshuffling, nearshoring trends.
Right, it's more than just tariffs.
Exactly. And trade dynamics are hitting investments too. There's a significant strain between the U.S. and South Korea right now. An immigration raid happened at a Hyundai and LG battery plant in Georgia. It caused months of delays due to labor shortages. Over 300 workers were detained.
Oof.
Yeah, apparently images of shackled workers caused outrage back in Korea. South Korea's president called it baffling, warned it could impact future investment in the U.S. if they can't sort out visas for skilled workers.
That's a real contradiction, isn't it? Trying to bring manufacturing back, but then creating labor issues.
It really highlights that tension. And just briefly, elsewhere, in Brazil, former President Bolsonaro was sentenced to 27 years for plotting a coup. The U.S. has weighed in, warning it will react accordingly to what it called a witch hunt.
So domestic politics in key countries definitely having global ripple effects. Okay, as we start to wrap up our deep dive, let's just quickly glance at the investing.com economic calendar. Any immediate events coming up we should flag?
Yeah, looking ahead, the big one we already mentioned is the Bank of Japan policy decision. That's September 19th. Key for currency markets.
Right.
And while we've hit the main points for today, September 12th, the calendar also lists the release of the CFTC speculative net positions later today, around 3.3 Euro PM US time. That covers positioning in things like the British pound, yen, euro, crude oil, gold. It's backward-looking data, shows where traders were positioned.
But still gives you a sense of sentiment.
Exactly. It offers valuable insight into market positioning, how the bigger players have been leaning.
Okay, great. So we've covered a lot today. Shifting Fed expectations, global currency moves, tech booms, geopolitical friction. Given all these complex, interconnected forces pulling in different directions, here's a final thought for you to chew on. How much genuine control do central banks and governments really have over the global economy these days? And maybe more importantly, what does that imply about the resilience and adaptability needed from individual investors like you in the long run? Something to think about.